Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger and Associates Financial Planning. I'm delighted to have Nick DeVito join me, one of my staff CFPs. Nick, thank you for joining me.
Thanks for having me.
We are doing case studies again. And as I introduced in the prior episode, many people aren't aware of the fact that not only do we have these on various iTunes and wherever you find podcasts these days, I don't know, but we're also on YouTube. We have a YouTube channel where you can get the actual video. So if we're showing slides, that may be helpful. Today, not as much, but it does help to see it.
Yeah, I mean, sometimes we'll have charts and figures
Exactly.
are a little bit better to see than...
Exactly.
So.
And they can also be found on our website, www.maaplanning.com. MAA is Menninger and Associates Planning.com. How creative am I?
Man.
So anyway, so we're picking up on the case study. That this is episode 2 of the case study. Remember that the purpose of the case studies is predominantly we identify clients that we meet with who have a myriad of different things going on that we find that, we'll change the name and change a few of the things, but what it does is it provides us with ideas of what we can talk about that probably some of it applies to the viewers or the listeners. And that's the whole idea. And again, Financial Planning Explained, the fundamental of the show is to provide an educational experience for the viewer and hopefully a little entertaining.
Yeah, I mean, not only can it directly apply to you, it allows the viewer to kind of understand how we think about things. When we look at a situation, what are some of the first things that jump out to us?
Right, exactly. And so one of the things I always tell clients, I say, we got one giant advantage over you. And they're like, oh, well, it's because you're a professional. Yeah, okay, fine. We've been doing this for however long. But actually, one advantage that we have over clients is that we don't have the same emotional attachment. Okay. And it's remarkable how the emotional attachment can cloud people's judgment.
I mean, it makes sense. It's your life savings. It's everything you've worked for. So it's hard not to get emotional about it. But that's the unbiased opinion we can provide.
Right. Exactly. Plus our experience.
Yeah, that's a little part of that, I guess.
All right. So anyway, why don't you give some of the basics associated with Betty?
Yeah, so kind of jump back into it. Betty is 56 years old. She works for a large public company. She makes about $160,000 a year. She's never been married. She has 2 adult children. Both are out of the house, off the payroll. And then she has about $1 million in pre-tax retirement assets, so her 401k and her IRA. And then she has about $300,000 in a non-qualified regular investment account. She owns her own home, and she does not have any debt.
Right. And so we left off at the end of the last episode. We were talking about, because she works for a large corporation, large corporations oftentimes provide a variety of different benefits that you may not see in the smaller companies. Yeah. So stock options, restricted stock units, which are also called RSUs, the employee stock purchase plan, which I usually love, and we'll talk about it. I don't love theirs as much. It's probably the weakest one I've ever seen, but be that. And then, the life and disability insurance and their 401k, et cetera, et cetera. So that's where we left off, which is where we're picking right back up again.
Yeah, and just for some perspective, I mean, a lot of times, most places have a 401k or some kind of retirement plan available to their employees. Right. A lot of places will offer the life and disability. I would say it's the larger firms where you're really going to start getting into the ESPP, the stock options, and the restricted stock units. That's really where you're going to start seeing those.
All right, so you want to start with RSUs?
Yeah, so in the case of Betty, she gets these RSUs every single year, and it's a 5-year vesting schedule. She currently already has about $50,000 in employer stock, either from previous RSUs, stock options she may have exercised. So she does have some exposure to her company stock already.
So that raises another issue, okay, is being overly exposed in your own company stock. I've seen...
We had someone the other day that...
It's right. Like 50% of their $4 million in retirement assets are tied up in company stock. Okay. And I've actually had it where I've had a client who came in to talk to us about establishing college savings plans for their children. And when I found that $850 of their $880,000 of their net worth was tied into their own company stock, that is like a triple-edged sword. Yeah. If the company does bad, that's going to have an impact on your ability to have a job, your ability to get bonuses, and now all of your net worth is tied up into the company's
Yeah.
stock.
You have to be very careful about being over leveraged. And I mean, it can be tough sometimes. If you've been working for a company for a while, they've been doing well,
Right.
stock is only appreciated since you've been there. It's hard to kind of get wrapped up in everything, especially if you know the company's doing well. But I mean, diversification across anything, not just company stock, is always important. It protects you.
It does.
Something happened to, if you're overexposed to one individual company, one stock, and something happens to them, well, there's not much you can do about that.
You also find a lot that people drink the Kool-Aid. Okay. And they're like, wow, the company's only goes up and this, that, and the other thing. Well, the interesting part about that is they don't realize that they're talking about the stock market, but they only think of it in what they know.
Yeah.
And what they know is the company stock.
Yeah.
And it's done nothing but go up. And there's and then I've actually gone and looked back at it and have found that their company stock has grown an annualized rate of return of 7%. I'm not complaining about 7%, but it's not as
It's not beating the market.
right.
for a
It's
long
not
time.
beating the
So
market. It's not even close.
and
to
you're
beating
taking
the
it.
market.
How much extra risk are you taking on for that 7%? It's
Right.
not quite worth it. So I
Right.
mean, we see that all the time, and especially when you have a plethora of benefits available to you that are giving you the employer stock. She has the options. She has the RSUs. She has the ESPPs. So that's
Absolutely.
3 ways in which you're. And then she might have it available to her in her 401k. I don't think she has much exposure to it in
Right.
401k, but that's another way that you could see the exposure to the company stock is within the 401k. That's oftentimes available to you as well. And I know when we're looking at this and we're deciding if you're getting the RSUs, you're going to get them. You're not necessarily choosing to get them. They're awarded to you and they vest over a period of time. The big question is, well, when you get them, do you keep them? How long do you keep them for? Do you try to sell them right away?
But the RSUs,
The RSUs are any kind of
you're thinking stock options. RSUs are given to you,
Yeah.
and when they mature, they automatically become yours.
Exactly. And then, well, I'm saying more so the holding or the selling of this RSUs when they vest and when you get the stock.
Right,
in
do
your
you
account.
decide
I'm
to
saying,
sell?
do you decide to sell? And I know one of the questions we always ask people is, say they have $10,000 of RSUs that goes into
Right.
their account. It's, if I gave you $10,000, would you buy your company stock with it? If the answer is no, then sell
Then
and
why in the
diversify-
world
then-
are you holding this
Exactly.
$10,000 in company?
That's kind of one way we get clients to think about it is, would you buy this on your own if it wasn't in a form of an RSU or an option? Or
Right, because it's just given to you. But see, the other thing about RSUs is it's important to know, particularly in Betty's case. Okay, they gave her the RSUs. Just talking about the restricted stock units. What happens a lot of times, let's just say they gave you 500 shares of stock in the form of an RSU. And you have a 5-year vesting schedule. What that usually means is at the end of 1 year, you get 100 shares, poof, they're given to you. At the end of the second year, another 100 shares, poof, they're given to you. But if you keep getting them, every single year they keep giving you RSUs, every year you're cashing in on 5 years worth of RSUs. Like today is 2024. I'm going to be cashing in on the 23s, the 22s, the 21s, the 20s, and the 19s. So this is actually a way that companies like to do the old golden handcuffs, because what you really need to do, and it's the summary plan description, you need to take a close look at it. But if you leave the company, forget retirement for a moment, if you leave the company and you're leaving all of your unvested RSUs on the table, that could be a lot of money. And if it's a lot of money, that's the company's way of throwing the golden handcuffs on you.
Yep. And that's why it's so important to look at that summary plan description. Just for some clarity, the summary plan description is basically the end all be all for 401ks, any plan or benefit you have available to you. It'll tell you everything you need to
The
know.
rule book.
So yeah, so it's a rule book. So with the RSUs, it'll tell you how the vesting works. Sometimes I've seen where if you're over a certain age and you leave, everything becomes vested.
Right.
So it's just important to know the rules, especially if you're, in her case, I mean, she's contemplating retirement or at least gearing up for retirement. So it's very important to know, when I retire, how much of this am I going to lose? Whether it's the options, the RSUs, or whatnot. It's always important.
And it's remarkable how many people don't retire simply because they don't want to walk away from those RSUs. Yeah. And so you're right. We've seen the full plethora. We've seen people retire and all their RSUs will be continuing on their vesting schedule. We've seen other people that the moment they retire, poof, they're all gone.
And then there's sometimes in between where if you retire after a certain age, maybe a percentage based on years of service or whatnot. So there's a full array of none,
correct,
all, and there's that whole middle area too. So.
And it's shown where?
The summary plan description.
Summary. I love, by the way, the summary plan description. I just reviewed one the other day for a 401k.
Mhm.
I love summary plan description. Sounds to me like it's going to be like the executive summary, 2 or 3 pages. This was 193 pages.
Yep.
The summary plan description.
It's just a plan description.
I would hate to see the big one.
Yeah. Yep.
So anyway, so anything more to talk about with RSUs?
No, I mean, we could dive a little bit into the taxation of them because that is an important.
It is.
Not necessarily. We don't have to spend too much time on it, but essentially every year that they vest, there's a tax impact. That's income to you.
Correct.
When they vest. A lot of times, what you'll see is they sell the shares to cover the tax for you, so they'll take care of the tax rate, but it's just something to be mindful of.
So to use my example from before, if there's 100 shares, what happens is that when those 100 shares become vested effectively, let's say it's $20 a share. That means I've got $2,000 worth of stock being given to me. Well, guess what? That's considered income. That's considered a benefit. It's like W-2 income. So government wants their money. So what they'll do to pay taxes on it is they'll literally just sell 40% of the shares. So they sell 40 shares at 20, and that generates the $800 that pays all the different taxing authorities. And I walk away with 60 shares. Now, I got an anecdote for that. One time I was at I went to his office. And the reason why I went to his office is because of the fact that he has his intranet, which enables for me to be able to sit there with him and take a look at all of his benefits. So fine. So he's going through all these different things, and all of a sudden he comes across his fidelity statement and then shoots by. I said, "Whoa, go back." So what's that? He goes, "I don't know." Turns out that he had $130,000 of company stock that he had no idea he had. All right. By the way, he likes me.
Yeah. Good day.
Found $130,000 worth of stock that he didn't know he had. And the reason is because it's what's referred to as a cashless exchange. If you're not actually looking at your pay stub, you're not getting extra pay. So what they were doing is they were taking that 60% of the shares and just socking them over here into this brokerage account with, I don't remember, it was a Fidelity, obviously I just said that. It was in his Fidelity account. He had no idea it was there.
Yeah. Not a bad day. Not a bad day.
Exactly. It's actually a good day.
Yeah.
Found money.
Yeah.
Like when you put on a pair of pants, you find $20 in there. Like, cool.
Yeah. If I found 130 grand in my pocket, I'd be pretty.
Yeah, but that would probably right. That would be that's fun.
Yeah. So moving on from the RSUs, she also has the stock options available to her. So they're non-qualified stock options. Currently, she has $75,000 worth of options that are unvested, $45,000 that are vested. I know in her case, she has not been exercising them over the years. They've kind of just been sitting there. She has a lot of exposure to the stock, so she doesn't necessarily need to exercise them. At least that's what she had been doing in the past.
So stock options are tricky. Okay, typically stock options are issued. You got vested and unvested.
Mm-hmm.
Okay. What they'll do with a stock option by rule is the whole idea is that they want the employee to become vested in the success of the company.
Mm-hmm.
Okay. So when they're issued at the price of the stock that day. So, so if the stock is at $20, they issue, let's say, 1,000 options for 20. And the whole idea is that they have different vesting schedules, usually 1 year, sometimes 2, sometimes 3. Okay, at which point, if the stock is now at $25, I can exercise the options and get that $5 difference.
Yep.
Okay. And it's considered to be ordinary income, which is important to understand when it comes to tax planning because it is also subject to wage tax, which is Social Security and Medicare, and the state tax,
yep.
local tax if it's applicable, as well as federal income tax. So, and the same goes with RSUs.
Yep.
So when you're doing tax planning during the course of a year, you need to know when these are landing.
Yeah, and just to clarify, the taxation is based on the difference in the strike price, which is the price they're offering it to,
Right.
and then the current value. So I think Mike said it. If they give it to you, your option, you can exercise at 20, it's now worth 25. You're paying that tax, Fed, state, local, FICA, on that $5 per share.
And so the tricky part comes when you have a whole slew of options that were issued to you at different times and they're considered vested, which means you can then exercise. Okay, this is where it gets fun. Okay, is when's the best time to time it? Okay, when's the best time to sell it? Which one should I sell? And then oftentimes you're going to have periods where at the end of 10 years, it's they expire.
Oh yeah.
Okay.
Yep.
And then the same goes in her case, is that if she's planning on retiring, it's important to understand what the rules are. Now, we've had multiple different things again. We had a client just recently who, when he retired, he had to exercise all of his options within 90 days. Dude, he had 20,000 shares. Okay. Actually, no, I'm sorry. 34,000 shares that were worth about 100,000. And gosh darn it, the moment he retired or right before he retired, stock dropped like a stone. And we were constantly watching it. And every time we saw it go up, we're like, sell some.
Yeah.
You know, that is as nerving as one could be. We had another client, same thing. They had 6 months, and lo and behold, this was in 2022. Okay, the stock was dropped. It dropped from 300 down to like 180 in that 6 months.
Something you can do.
Yeah, but you know, I tell you what, you want to talk about nerving?
Yeah. Oh,
That's
I
it.
bet.
You know, so it's important to understand. It's also very important to understand if, in Betty's case, she's 56 and planning to retire at age 50, if she looks at her summary plan description and identifies that upon retirement, you've got 90 days, then she needs to be thinking well in advance of retiring as to unloading some of those options when you see a good price.
Yeah, and I mean, the timing is always very important, as you mentioned, because if you're looking at it, you know you're going to retire in March of a year. Well, that might not be a bad year to exercise these options and take the income because you're not working the rest of the year. So kind of playing the tax game and timing it from a tax perspective is also important too.
Absolutely. Absolutely. All right. So I tell you what, we're going to go on break.
Yep.
And then we'll pick up with what's after stock options.
ESPP.
Oh, the ESPP. All right. So stay tuned. We'll be back with you in just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger & Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back, and we're talking about Betty, and we're continuing on with the case study. In the first segment, what we were talking about is some of her employee programs. We talked in depth with her RSUs and stock options. Now we're going to talk about the employee stock purchase program, the ESPP. I've seen some really good ones, and I've seen some that aren't quite as good. And I will tell you, on the end of the spectrum, this is the worst one I've ever seen.
Yeah, and just to kind of give it that, unfortunately, that is the case. Just to give you a little idea of how the ESPP works is there's always a purchase period.
Right.
So most of the time you'll see it's 6 months. So during that 6 months, you're contributing to the account. So it's accumulating the cash as you go along. Now you're paying the tax on this, so you're not getting a tax deduction for this. At the end of the purchase period, you then have the opportunity to purchase the employer stock with the money that you had been accruing throughout the purchase period. And what Mike is referencing in terms of this one's not as good as others, as you may have seen, is you're getting a discount off the employer stock. It can be anywhere from, I guess, technically 5 to 15. 15 is the max, generally speaking. Now, when the purchase date is what can kind of vary from plan to plan. Some plans, it'll be whatever the stock price was at the end of the purchase period, you're getting a discount off that. Some will say, they look at the stock price on the beginning of the purchase period, the end of the purchase period, you can take the lower of the two. Some say you can take the lowest point throughout the entirety of the purchase period. So there is a lot of variability. In her case, she has a 6-month purchase period. It is a 10% discount that she's receiving. And the purchase date is at the end of the purchase period. So there's no, you get to pick the lower of the two,
right,
lowest. It's just 10% on the last day. She can withhold it up to 10% of her base salary can go towards the plan, and she's currently contributing 5%. Her plan in particular does not have a holding period, meaning she can buy the stock and then the next day sell it.
Right.
Some will have a purchase or holding period required, meaning you have to hold it for 6 months, a year, 2 years. It can vary. Once again, it's all found in that summary plan description.
And I believe this is this way because of the fact that you're buying it on the last day.
Yep.
And actually, I'll tell you what I think stinks and is unfair about it is that, let's say it's July 1st and I'm buying the stock at 40, but it started the year at 20. I'm putting money away the whole time while the stock is 20, 25, 30, 35. Now it hits 40. I'd have been better served just putting the money in and buying it on the open market.
Yep.
Okay. And then what happens here, so let's say, for instance, she's buying it at 40. She effectively gets a 10% discount, which is 36. The moment she sells the stock, she has to pay tax on that $4. So if she's, by the time you add up all the taxes, 40%, she's really only getting a 6% discount.
Yeah.
But
Still 6%.
6% beats zero.
Exactly.
So,
Because, I mean, we love to see this. If people have the cash flow to put towards this, we always recommend that they do, because it's, I don't want to say free money, but you can guarantee, if you can lock in a 6% rate of return on your money, would you do it?
oh, absolutely.
Exactly.
Exactly.
So, I mean, in her case, one of the things we recommended, she was cash flow positive. So we said, look, you're currently doing 5%. Let's bump that up to 10%. It's not the best ESPP out there, but if we can guarantee that 6% rate of return on your money, we're going to do that every time.
Exactly. And, that's when we also tie in RSUs, we tie in stock options, and we tie this in. And if it appears as though she has too much money tied up into one company's stock, and given this program, this is probably the first one we ditch.
Exactly. Kind of looking at broadly from an employer stock standpoint. So just a reminder, she has the RSUs, which have been given her stock. She has the stock options available to her, and the ESPP. So like I said before, increase that ESPP to 10%. Do we sell right away? In her case, we said yes. You don't necessarily need the additional exposure to your employer stock. You have other avenues. You have more RSUs that are going to be vesting, so we don't need to hold on to it. Any share, we recommended that any share that she has, any employer stock that she has that's at a loss, we sell that, capture that capital loss,
Right.
and use that to help offset any gains or ordinary income. And in her particular case, we're talking a little bit down the road, she's flirting with the 24% tax bracket and the eligibility to contribute to the Roth IRA. So from a tax perspective, we didn't want her to take any gains, so we didn't have her sell any of her stock that's at a gain.
Well, not for the Roth IRA, but what about the Roth 401k?
We'll touch on that a little bit more in
Right,
terms of she's currently contributing to the, we'll talk about that with 401k. She's currently contributing to the traditional 401k. We'll talk a little bit more about the Roth 401k later.
Okay, perfect.
Yep.
Perfect. So now you're talking about some of the other ones. You got the disability
Yep.
and the life insurance.
Yeah, so in her case, she has both short and long-term disability available to her. The short-term is 60%, so it'll be a 60% payout if she were to become disabled. 5-day elimination period. Her employer pays the premium, and she can buy up to 80%.
Right.
So now with disability insurance, short-term in particular, when you see the term elimination period, that's how long you have to be disabled before you can claim your benefit,
Right.
if you're not familiar with that. If you see that the premium is paid by the employer, that almost certainly means when you receive that benefit, it's taxable to you.
Right.
Now, in her case, she can buy up to 80%. So she can buy up an additional 20% of insurance. If you're buying that up, you generally have the ability to say, do you get the tax deduction for it, or do you pay for it with after-tax dollars?
And surprisingly, we always recommend after-tax dollars.
Yes, and we do that because if you're already taking a reduction of your income, do you want to have to pay taxes on top of it? And also, the cost to buy up is a few dollars a pay period.
Yeah, it's not that much.
You're paying taxes on a few dollars to receive 20% of your income tax-free.
Correct.
So we
Correct.
always recommend that they go after tax.
So the elimination period typically for short-term disability is 1 week, and that's what it is in her particular case. Then oftentimes, when they offer long-term disability, short-term disability typically is 90 days. Sometimes I've seen it for 6 months.
Yep.
And then what happens is that they have that coordinated with long-term disability. And then long-term disability kicks in the moment short-term disability is out. So it's either, they call it 13 weeks or 90 days. And then, so your long-term disability will have a 90-day or 13-week elimination period. which is covered by the short term, and then the long term kicks in. And the long term, got to look at the summary plan description on that. Not exactly the summary plan description, but got to look at the rules.
Looking under the hood.
Does it go for 2 years? Does it go for 5 years? Does it go to your age 65? And that's what you're going to want to understand as far as that goes. And if you have the ability to buy up long term, that you also want to be able to do, because you lose your job. That's your biggest risk of bringing home a paycheck.
Yeah.
And disability is, it's tough, and it happens more often than you'd think.
Yeah, we have a few clients that we have had several clients over the years that are claiming their disability insurance, and you never think it's going to happen, but that's the purpose of insurance, to protect an incident like that. For her in particular, she does have long-term available to her as well. It is still that 60%. She cannot buy it up anymore any further than 60%. Like Mike said, it picks up right after her short-term ends. Now, what is interesting about hers, and I haven't seen this, you may have seen this more often than I have.
I know the rules have allowed for it, but they haven't figured out how to do it.
So in her case, she has the ability to pay the tax on the employer premium.
Right.
So she can say, the employer's paying for the benefit. She can say, I will cover the tax on that. And what does that do for her? That means that she will be getting a tax-free benefit for long-term disability should she become disabled.
Right.
So similarly to the short-term disability, we said if you can pay after tax dollars, we'll absolutely have her pay the tax on the long-term disability so that she can receive 60% of her income tax-free.
Right. So if the company is spending $100 a month for her long-term disability, then what happens is that they'll just include that as imputed income is the term. It's basically they count it as income of $100 that is subject to taxation. So her paycheck goes down by what? $35-$40.
Yeah.
So she's paying for $35-$40 to get her long-term disability to be after tax. And if you think about it, first of all, it's not uncommon that they cap it at 60%.
Yeah.
Particularly if you can get it after tax, because I'll tell you what happens is that if you're receiving long-term disability after tax at 60%, your paycheck is going to be almost identical to what it was before you were on disability. And certainly the disability companies don't want you to be making more money on disability than you were at work, or else what's your motivation to go back to work and get off of disability?
Yeah,
so
exactly. She also has life insurance available to her. So the one in particular, hers is set up that it's 2 times her annual compensation. The employer's paying the premium. She can buy up to $3 million if she wants to, but we really didn't feel that she had any need for additional life insurance. I mean, what is life insurance doing? It's essentially protecting your income should you pass away in the broadest form of it. At this point,
protecting your dependents.
Yeah. So at this point, she doesn't have any debt. Her 2 children are out of the house and independent, so no one is relying upon her income. She has a little bit available to her. It's not necessary that she even has that, but we didn't see there was a need for her to buy up any more than she had.
The other thing, too, about insurance, and we've had episodes on it, and we've talked about it before. I'm a big fan, let's just say, that life insurance is rated based on only 2 things, gender and age. Actually 3. Gender, age, and tobacco user.
Yep, and that's the employer life insurance.
That's correct.
Yep.
So what happens is that if I am the same age and gender as the person sitting next to me, and I'm a marathon runner and he's 450 pounds with heart disease, cancer, diabetes, and whatever else, we're paying the same rate, which means he benefits from being able to get it through the company at a group rate. Me, on the other hand, I'm the marathon runner. I can go out and get life insurance on the outside and pay less.
Yep.
So I encourage anybody who is utilizing and relying on their company for life insurance that they should check into going outside. And the other thing too is at the company, it's what's called age banded. And we took a look at this, did it recently.
Yeah.
So we look at it, and people live in between 40, they're in their late 40s, and we said, you want to get 15-year term. 15-year term insurance is the same premium for 15 years. On the surface, you're like, well, wait a minute, we're paying more now than what they're paying for at work. But every 5 years, their insurance rates go up, and they go up a lot at work. So if you're better than average health, you're actually better served getting life insurance on the outside, usually, usually,
Yeah.
because it's also portable, because now you're not relying
Yeah,
on
that's
your
the big
employer to be able to provide life insurance. And if you can get life insurance cheaper on the outside and it's portable and you're not relying on the employer,
Yeah, it's a no-brainer.
right?
Yeah,
Exactly.
We always take a look at that when we see people have life insurance available through work. I mean, especially if they have younger kids or more dependents, that's really when we're diving in and saying, okay, is it more cost effective? Is the portability worth them having it outside of their employer?
Right. As you can see, I'm trying to get this done in this episode.
Yeah. Oh.
So the 401k is the last of the things and of the employer benefit programs. And again, most people have a 401k available to them. Some people may have alternatives to simple IRAs or whatever. But basically, the federal government is trying to encourage employers to create 401ks for everyone to save for their own retirement. And more recently, actually since 2016, which is very not recent anymore, Roth 401ks are prevalent. Okay. They don't have to be in the plan, but it costs the company no more to have it in the plan. And basically, we've had several discussions and episodes on the difference between traditional and Roth. And what we look at is, what is your tax bracket today versus what it is anticipated in retirement. If we project that your tax brackets are higher in retirement, then why in the world would you be taking a tax deduction today to pay a higher tax on it later?
Yeah, and that directly applies to Betty. I mean, she's within the 24% tax bracket. She's currently contributing to her traditional 401k. So for her, we looked at that and said, we think you're going to be in a higher income tax bracket later. Let's not take the deduction now. Let's pay the tax now. We switched her to Roth. So for the remainder of the year, she switched to her Roth 401k.
All right, and so for a real quick overview, why is it good that she's going to be in a higher tax bracket later? 24% is her current tax bracket. She makes an extra $1,000 contribution to a 401k that's deductible. She gets a 24% tax deduction, but then she has to pay the money on the way out. Okay, not only is she going to be paying money on that 1,000, but the 1,000 plus growth. Okay, and the other thing that happens is that tax brackets are expected to go up. And when you factor in the the fact that Social Security taxation is based on what your other income is, the money that you're taking out of your IRA and retirement is going to subsequently cause your Social Security to become taxable. So that even if you're in a 15% tax bracket, your effective tax is 27.75%.
Yep.
And why get a 24% tax deduction to pay 27.75? Not to mention the risk of having to pay IRMA, which is income-related monthly adjustment amount, which is a short for saying your Medicare premiums go up because of your income.
Yeah, I mean, for her, she has the cash flow to max out her 401k. So that means she's getting $23,000. She's over the age of 50, so she can do that extra $7,500 worth of catch-up. So she's getting $30,500 into that Roth 401k,
Right.
which is a beautiful thing.
Absolutely. It's a beautiful thing. What else can you say? And then at age 59 and a half, poof, it's tax-free.
Yep, exactly.
Right? So let's just figure out some of the things that we did for strategies, and then we'll wrap this thing up.
Yeah, so I mean, kind of going back to her balance sheet and looking at what she has available to her, she does have the cash in the bank right now with the CDs and just regular cash, but we generally recommend that people obtain a home equity line of credit. Why? It gives you access to additional liquidity in the event that you need it. So
Right.
She does have the cash, but it gives you a little extra wiggle room, and the beauty of it is, if you're not using it, you're not paying any interest on it. It's like a credit card. If you don't have a balance, there's no interest. So it's a great cost-effective tool to have kind of money insurance if you.
Absolutely. And you'd be surprised how many times you need it. Let's say, for instance, in her case, she needed $50,000 on the get-go. She may have to break a CD.
Exactly.
Okay. Or she may have to sell an investment that's down, or pay a big capital gain, which blows out her tax planning, or. Get it when you don't need it, because if you do need it, the odds are it's because you lost your job. And that's happened to me before. A client lost a job. I said, "You got your HELOC?" "Oh, gee, I never did get it."
Yeah, exactly.
Okay. So it gives access to money. And one of the most common ones that I have found really is, one of my kids wants to borrow $50,000 as a down payment on a house.
Yep.
And boom, here's your $50,000, and they're effectively paying back your home equity line of credit. But you're providing that to them. Or you want to buy another home, you want to move. Hey, I'm going to use my line of credit as the down payment on a new house, and as soon as I sell the old house, then I pay the line of credit. So There's a lot of reasons to use it.
And in her case, she's approaching retirement. So going back to what you said is you need the income when you're applying for the home equity line of credit.
Right.
So get it before you retire. So that way in retirement, you have it accessible.
Right. You've got it accessible.
While you have the income. I mean, we kind of already touched on the other strategies with her. Switch her 401k contributions to Roth. And we talked about potential Roth IRA conversions. Now we were weighing out, with her in particular, do we contribute to the Roth 401k or do we convert? So we were kind of balancing that because she's very close to the top of the 24% tax.
Oh, is she that close?
Yes.
Because the $160,000 salary wouldn't put her there, but she gets
She's the
like,
RSUs.
she's stock up.
She's close. So
Right. So, and that's why we look at that stuff. Because if she blows through, which is somewhere about $190,000 taxable income, which is around 205 of adjusted gross income, she blows through. Now she's paying 32% tax. Well, 32% tax is not worth, in her case, is not worth doing it. Okay.
And then just some other kind of general retirement considerations we had for her. We touched on this a little bit. So her question was, can I retire at 60? And where our wheels start spinning, where our mind goes to is, one, what's your cost of living? Two, healthcare. How are we covering that gap from age 60 to 65, at which point you can get onto Medicare?
Which, by the way, some companies
Exactly.
also offer retiree health benefits.
Yep. Once again, Social Security. Strategies behind when do you take Social Security? Do you take it at 62? Do you delay? In her case, it's a little different because she wasn't married, so you're not playing the maximization game where you might be playing with a spouse, where one spouse takes it at 62, the other one delays until 65, 67, or whatnot.
Right.
Taxes. I mean, taxes are involved in every decision you make when you're doing financial planning. How do we mitigate taxes, especially when we're drawing on your retirement accounts between when you retire and Social Security, and then when you're on Social Security, further maximizing your taxes, because if you take more income, more of your Social Security becomes taxable. So that's always something to keep in mind. And then, is there going to be other income sources? I know some people, they say, I want to retire. I don't want to fully retire. I want to do something else part-time.
Keep myself busy.
So is she thinking about that? And that's just some of the things that we're thinking of when someone asks us that big question of, can I retire?
Right. Of course. And, one of the big issues is that let's look at her case, not necessarily in her case, but, she's had a very long and successful career. If she retires at age 60 and decides 2 years later, I can't afford to live, I need to go back to work, the odds of her getting that job at that income level at age 62 is not very good.
Yeah.
So if you're going to pull the trigger, you want to make sure that you're doing it.
Yep, exactly.
All right. Well, thank you very much, Nick. That was very good.
Thanks for having me.
We kind of went a little quick because we squeezed this into 2 episodes, which I would have rather have done anyway. But once again, we're trying to get all this information in, and for the sake of you, the viewer or listener. So I hope you had a good time. I hope you learned something today, and see you next episode of Financial Planning Explained. Have a great day.